All right, good morning. Oh, I don't think it's working. Maybe not?
No, it was working perfectly.
Oh.
All right, is it working now? Yeah, thank you. Thanks a lot. Good morning. Thank you very much for having the paper and the program. It's a great pleasure to be here, and especially in person. I think you can take that off, right? Yeah, thank you. All right, so this is joint work with Leah Stern, who is from the University of Washington, and this paper is titled Venture Capital Misallocation in the Age of AI. So since this is a FinTech conference, I want to start with, reminding you of how important venture capital is. In the words of Ken Arrow, venture capital has done more than basically anything at improving efficiency. Venture capital has been shaping the world economy's innovation for the past 4 decades. It's the main source of funding for high growth entrepreneurs, and there is more and more capital being invested into venture capital. And today, I'm sure you all know that it's a really booming industry. Despite the importance of venture capital, we still know very little about the decisions that venture capitalists do. And this is what this paper is about. On the one hand, venture capitalists are very sophisticated investors who have very strong financial incentives to do well. They have incentives, experience, institutional knowledge. They do due diligence on firms, so they know a lot about the firms that they select. However, they are subject to frictions, right? Papers out there try and explain how VCs make decisions, and we know that they look at a limited number of firms because it takes so much energy, effort, and money to do due diligence and to select firms to invest in. They just cannot keep track of all the firms that they could invest in out there. So this is one main thing that we're going to look at, the frictions that VCs face. The second thing is that VCs are simply humans, right? And as humans, they might be subject to bounded rationality. They might draw inference based on small samples, heuristics. They might be subject to biases, and actually a lot of papers in the literature have documented the occurrence of such biases in VCs' decisions. So we sort of know that there are frictions and biases, but we don't know the extent to which they matter for venture capital allocation. And this is what this paper is about. What we do is we are going to conduct a scoping exercise where we ask whether machine learning prediction can help us understand VC's decisions. And our analysis is going to be centered around 2 key building blocks. The first one being estimating the shadow price of the frictions that would prevent VCs from investing into the most promising startups. And the second building block is we're going to really open up the black box of VC's decision-making to shed light on how they select the firms that they invest in. How are we going to do that? I'm going to tell you exactly how we do that, but in a nutshell, what we're going to do is we're going to build a machine learning algorithm tasked with predicting firm performance. And then we're going to build an algorithmic policy that selects firms that an algorithm would invest in. And we're going to compare the firms that an algorithm would select to the ones that are actually being invested in by VCs. All right, and we're going to do so and then we're going to build a model to try and predict VC's decisions and see how that model differs from the one that predicts firm performance. So let me get more into details, and I'm going to start with the data that we use, emphasizing the advantages of this data for the exercise that we conduct. Then I'm going to talk about the algorithm design and its performance at predicting firms' success. And then our 2 main results will be on the shadow prices of frictions and on how VCs actually select firms. All right, so the main data source that we use is an entrepreneurship survey made in France every 4 years. It's conducted by the French Statistical Office, so this is administrative data. It's a mandatory survey, so the response rate is very high. It's conducted on approximately 1/3 of entrepreneurs per cohort, which means we have about 30,000 observations each year of the survey. And it's very representative of the entire population of startups in France. Every year it's conducted. It has a wealth of data on entrepreneur and startup characteristics at birth, up to 465 variables that I'm going to tell you about in a second, including age, education, the gender, experience, and a wide range of things. The main advantage of this data set for our purpose is that we can bypass the main problem of machine learning applications, which is the selective labels problem, because we can observe both those firms that are VC financed and the firms that are not VC financed. And it's pretty unheard of. Most papers out there on venture capital only have data from commercial databases that are produced by VCs and therefore only have access to data on venture capital backed firms. We have both VC backed and non-VC backed firms. Other advantages of our data is that we have no survivorship bias and no selection bias. Some people have said that the venture capital data set out there, they only report those firms that perform well because they don't want to look bad. Okay, so we don't have that problem. We have administrative data representative of the entire population, and we can match these data with accounting data, again, from administrative sources that allow us to look at the operational performance of firms from their birth until their death. And we're going to complement this data with some other commercial data sets on M&As and IPOs in order to look at successful deals per se, as I will show you in a second. All right, let me talk about the algorithm design and the performance of our algorithm. What do VCs do? VCs' job is to try and find firms that they want to invest in. Which firms are they're going to select? The firms that they think are going to do well, right? VCs have incentives to invest into firms that are going to be successful. So in a way, VC's decisions can really be cast as a prediction problem, which makes it an amazing opportunity for us to use supervised learning algorithms that are really tasked at predicting some form of objective. What objective do VCs pursue? We know that VCs want to maximize the returns on their portfolio firms. And what we need is a measure for our algorithm to be trained and learn to predict that we can observe for all firms, not only the VC-backed firms, but really also the firms that are not VC-backed. And so the advantage of our data is that we do have some measures of performance and success for all firms, and it's going to be operating performance. And again, we have it for both VC-backed firms and non-VC-backed firms. Our preferred measure of success in this paper will be the log of value added at age 5, okay? Our results are not, are robust using other methods. The reason why we use this one is, again, because we have, this measure for all firms, but also because it's commonly used as a basis for VC's valuation. They look at future operational performance times some multiple, and that's what they expect from firms in order to be successful. Okay, so this is the performance measure, the success measure that we're going to train our algorithm into predicting. Which algorithm are we going to use? We're going to use what the literature has said is the best algorithm for structured data, the gradient boosting tree, XGBoost. We're going to train it on 3 cohorts of entrepreneurs, 1998, 2002, and 2006. And then we're going to test it out of sample on the 2010 cohort. Why do we do that? We can also do random split as usual, but we want the algorithm to be on a level playing field with VCs. So we want to run the algorithm, train the algorithm on the earlier data and then test it on 2010 so that the algorithm would select firms that they know nothing about. There's no look-ahead bias or of any sort. They're like on an equal footing with VCs as of 2010 when they select firms in our test set. The input features that we're going to use, we're going to restrict to those features that we believe VCs can observe. Okay, we don't have an advantage over VCs in building and training our algorithm. All right, let's talk about performance. We have data on success of all types of firms. So if you look at all firms in orange here, this is how any French startup looks like after 5 years in terms of success as measured in log value added at age 5. In green, those are the VC finance firms. The first thing that you notice when it comes to the mean, at least, is that the average profitability of VC-backed firms is much higher, is 2.11, much higher than the average firm in the French economy, which means that indeed VCs invest into firms that will do well, that will do better than average. This is their goal. The second thing that you notice is that VCs invest into a lot of firms that actually go bankrupt or disappear by age 5, which means that they sort of go for what is called the Babe Ruth effect after the baseball player who was going for home runs. They try and find firms that are more risky than average, and they bet on magnitude over frequency. And finally, most importantly for us, we find that our algorithm is very good at predicting performance, so good that it gets an average profitability of 4.77 as compared to 2.11 for VCs. Actually, the riskiness, as far as we can tell, is kind of similar. The algorithm investment policy mimics what VCs do. It just does much better because it predicts so well future success, and therefore it can select those firms that are the most promising in terms of predicted success. I was telling you that we have a wide variety of measures of success that we try in the paper. One that I like in particular is trying to get at this home run thing. So this is what's hidden behind Baoyong. Okay, this is home runs. We're trying to go for not for Baoyong, but for home runs. And we ask, what if VCs care about a different measure, which is that they want to invest into firms that will get acquired or go through an IPO pretty quickly. So what we do is we merge our data with commercial data sets to have an exit dummy for successful deals. And this is a very high bar for our algorithm. Now we're trying to predict which firms are going to be home runs. There are only 56 such firms in the 2010 cohort. Let's see how VCs do compared to our algorithm when it goes down to predicting home runs. Out of 56 home runs in the 2010 cohorts, only 4 were VC-backed. Our algorithm could pick 13 when it had a number of firms comparable to the actual VC-backed firms. If you increase the number of firms selected by our algorithm, we get even more of those. So there are caveats to this approach, but we see it as very encouraging that even finding a needle in a haystack is possible for our algorithm. We also show that when our algorithm is trained at predicting one measure of success, it does very well on all other measures of success that we have talked about. And finally, we have some very cool results on explainable AI in the paper that I cannot go over that show you which variables predict success along different measures. We find that the variables, the features that predict home runs and our performance measure, our main performance measures, are the same ones, and that they push the prediction in the same direction. All right, so our algorithm does very well. There might be 2 concerns lingering around that I want to tackle before going deeper into the analysis. The first is that we know VCs have an effect on the firms they select, right? I mean, they monitor those firms, they provide them with resources, so those firms are going to do well. How does that affect our analysis? The second one is that perhaps they invest into firms that have some unobservables that we just cannot see, and maybe the firms that our algorithm will select would never have been invested in by VCs. Okay, so for the first thing, the VC treatment effect, that we call the VC treatment effect, if you think about it, it makes it harder for our algorithm to find firms that are not VC backed and that do very well. Right? I mean, those firms are not being held by VCs. If they do so well, then maybe they were just really good as of their birth year. So our only assumption here is that the firms that are being selected by the algorithm would not perform worse if they had access to venture capital at birth and the help of VCs. For unobservables, what we do is we are going to show that even within the set of VC-backed firms, the algorithm is great at predicting which are the ones that are predicted to do poorly versus well, so that even within the set of VC-backed firms, the algorithm can do better than VCs in a sense. And even when we train the algorithm on VC-backed firms only, which is a very restricted number of firms, the algorithm learns enough to do well at predicting, which we find as very reassuring. All right, let me go into the 2 main results that we have. The first one is on the shadow prices of frictions. This is, to the best of our knowledge, the first attempt at quantifying the frictions that VCs face in their job. The way we're going to do that is we're going to build center models that combine human predictions, VCs, and machine predictions, the algorithms. And we're going to assess how much gains could be generated if we selected firms using the algorithm versus VC's decisions. And then we're going to see how these performance gains change when we constrain the algorithm along some dimensions that resemble the frictions that we know from the literature VCs might be subject to. Here's what we find. So we start from 2.11. Remember, this is how VCs fare in reality, right? This is how the average portfolio firm fares after 5 years. And let's start with the unconstrained center. What we do is we ask the algorithm to rank firms among the VC-backed firms, to rank them according to their predicted performance. And we asked the algorithm, okay, as you go towards the right, you're going to drop those VC-backed firms that are predicted to do the least well. And so they're going to drop those firms one by one and replace them with firms that are not VC-backed, but that are predicted to do very well. And since the algorithm is so great at selecting firms, we find that as it replaces more and more firms in the pool of VC-backed firms, it ends up with the 4.77 that I showed you before, which is the maximum gains that could be produced if you were to select based on an algorithm rather than VCs. Of course, we don't think that VCs could actually invest into all those firms, which is why we quantify the frictions by constraining our central model to replace firms that are VC-backed by firms that are in the same industry or in the same location or in the same industry and location as the one that was dropped. Basically saying, okay, maybe you're investing into that startup, you could not have invested into any other startup in the economy, but maybe you could have invested into this other one that looks very similar and that actually we predict to do better. And so we can quantify and we actually estimate the shadow price of frictions as the difference between the unconstrained algorithm central model and the constrained ones. Even in the most constrained central model, which we find that the algorithm can do much better, almost 4 times as better as VCs. So what this leads us to think is that the algorithm is that, there are constraints that VCs face, but there still remains some things weird about what the decisions that VCs make, and perhaps there's room for errors in what they do. And so in the rest of the analysis, and in the rest of my remaining time today, I'm going to dig into how VCs select firms. We see that they select different firms from the algorithm, so we're going to zoom in on those firms that the algorithm selects, but VCs don't select, and vice versa. Okay, so looking at those firms that the algorithm selects versus the VCs select, we find the algorithm selects younger entrepreneurs. They select more female entrepreneurs than male entrepreneurs. They select more highly educated entrepreneurs. And they select less entrepreneurs that are based in Paris, which is kind of the hub for VC in France. And so, this leads us to think, okay, maybe there's something wrong about how VCs screen and select firms in the first place. In order to dig into that, what we do is we build a model of VC's prediction. So now our algorithm is tasked with predicting which startup is going to be VC financed. It's different from trying to predict which startup is going to be successful, as I showed you. And so what this AUC, this area under the curve here of 0.79 means is that if you took 2 firms at random, one being VC-backed, the other one being non-VC-backed, the odds of our algorithm predicting VC-backed firms, assigning a higher probability to the one that is indeed VC-backed is 79%. It's a very good estimate of VC-backed firms. And so our algorithm is pretty good at capturing which firms are going to be VC-backed versus non-VC-backed. And actually, interestingly, if we restrict our predictive algorithm to only 3 demographics, we find that much of the signal about whether a firm will be VC-backed is captured by 3 demographics: the entrepreneur age, their gender, and their education. Okay, again, this is 0.5% of firms are being VC-backed in the economy, and we do pretty well job at figuring out which ones are. So this analysis based on Lyonnet and Obermeyer's forthcoming QJE actually looks at VC's investment prediction, which is the model that I just showed you. And we find that indeed it is correlated with the actual decisions of VCs that we observe. We find that VCs seem to care about performance predictions based on our initial model. But we find that over and beyond the influence of performance predictions, VCs seem to have a model that deviates from a purely performance predicting one. So our model is correlated with VC's decision, but there's still a lot of predictability in VC behavior, and that's what I'm going to dig into within the 5 minutes remaining. 2? Okay, I tried. Okay, so the way we do that is again building on. Well, my iPhone algorithm is wrong. So how well do VCs use the features in their model? In order to understand VC's decision model and open up the black box of what they do, here's what we do. We're going to create simple models to predict firms' performance. What I mean by simple models is that we're going to restrict the set of features that our algorithm can learn from in order to predict performance. We're going to restrict it to features that we think VCs might care about based on the existing literature, and then we'll regress those the decisions of our restricted models on VC's decision and see how and whether it has predictive power over and beyond the effect of our initial model of firm performance. Here's what it means. We have that indeed our full model of firms' performance does explain why firms are being VC-backed. And when we restrict our model to a simpler one based on simply age, we don't find that VCs tend to overweight or underweight age in their predictions. However, when we have a simple model based on gender only, we find that gender seems to matter in VC's decision over and beyond the effect of gender on firm performance. So they do know that gender does explain some part of firm performance, but they turn out to overweight the importance of gender in their own decisions compared to how much gender explains firm performance. Find the same thing for education. There seems to be overweighting of education in VC's decisions, and actually underweighting of industry and location, very much aligned with the results that I showed you before. There's overweighting of gender and education, underweighting on firms' industry and location. The final exercise that we do is we confirm those results in some other way. We do a double sort of firms based on their probability of being VC-backed and their predicted performance. We create two sets of firms, one that has a very low predicted performance, but a very high chance of being VC-backed, and one that has a very high predicted performance, but a very low chance of being VC-backed. And what we find is we do just a simple t-test of differences, and we find that indeed those firms that have a very low predicted performance, yet a high yet a high chance of being VC-backed, are funded by older entrepreneurs, male entrepreneurs that are less educated, and we have a variety of other results that I cannot go over, but basically allow you to understand better what it is that VCs seem to care about and whether that makes sense from a purely performance predicting point of view. All right, I'm going to wrap up. We have a scoping exercise to assess the potential of algorithms to help us understand VC's decisions. We have amazing data that allows us to interpret our results in a general manner. We build center models to estimate the shadow prices of frictions, which again is like the first estimates we know of the frictions faced by VCs. We dig into VC's decision making by building an algorithm predicting VC's decisions. We find that they overweight certain characteristics and then underweight others. And we hope that this paper addresses some important open questions in the VC literature that have been raised in the existing literature. Thank you so much for your attention.
Okay, so thank you very much for inviting me to discuss this paper. So I'm very pleased to discuss Victor's paper. So this paper fits in the large literature that tries to understand what VCs do, and in particular, this paper asks whether machine learning can help VCs to make better investment predictions. And this paper basically using machine learning techniques to predict high-performing firms and compare AI selected firms to VC-backed startups. So one motivation fact for this paper is the fact that it exists there is a correlation between VC selected startups at start and the ones that are selected by the algorithm that Victor presented. So and it's about 20%, only 20% of firms are the same, like VC-backed startups and AI selected firms. And how do they show that? So they basically use this large-scale survey of French entrepreneurs that is matched with the tax files from the French Statistical Institute. So I know very well the data because I use them in my job market paper. And basically, this survey is conducted on cohorts. Okay, so every 4 years, 25% of the population of entrepreneurs are surveyed or receive the survey, and they self-report some demographic characteristics, ex-ante motivations, and financing sources that are available to startups at creation. So in the paper, they are going to do two things, basically. First of all, they are going to predict what are the high-performing firms, and they train the algorithm on 3 cohorts. Okay, so they use 465 predictors coming from the survey to make this prediction. And then they are going to use the log of the value added 5 years after taking the first wave of the survey to basically predict what are these high-performing firms. Okay, and in the second part of the paper, basically they compare AI-selected firms and VC-selected firms in this test sample that is like the 2010 cohort. And the two main results are like the two main results of the paper are, first of all, that the algorithm predict better high-performing firms than VCs 5 years after taking the survey. And they also compare in the second part of the paper the demographic characteristics of AI-selected firms and VC-selected firms. So Victor did a good job at presenting the result, but let me just like summarize them. So first of all, they predict, they show that like the algorithm accurately predicts future performance in terms of the value, the log of the value added in 5 years. To do so, they use this algorithm, and they include 465 predictors. So we have some examples of the predictors, and they are actually ranked by order of importance. And for example, the most important predictor in the algorithm is the fact that some startups, they use external services in terms of accounting for their performance. And also, for example, the number of workers, or the fact that the entrepreneurs was previously a self-employed person, and this is typically negatively correlated with high performance. So here we have like the most important predictors for the algorithm. Okay, so the second result of the paper is to show that AI-selected firms, so the ones that are selected by Victor and Leah's algorithm, actually have better performance than VC-selected firms. So they plot the distribution, and what is striking is that the difference is huge. Okay, so AI-selected firms, they have like an average performance of 4, or the log of the value added of 4.77 versus 2.11 for VC-selected startups. So we can decompose this performance in 2 parts at the extensive margin. So we can find that AI is better at predicting failure in 5 years. Okay, so firms that have been selected by the algorithm are basically have 70% of chances like to survive, as opposed to 20 for VCs. And the second thing is that AI is better at predicting also the log of the value added in 5 years. And this is the means I discussed earlier. And the second main result of the paper is that algorithm selects younger, more educated entrepreneurs, more female-founded startups, and non-Paris-based startups. And actually, this is like consistent with what the literature has shown. So, for example, in terms of who are backed by VCs, and the gender differences between VC-backed startups. So I have like 3 main comments. So my first comment is, do VCs actually use AI? Okay, so why is this exercise relevant for VCs? My second comment is, why do VCs fail actually at predicting what are the best startups? And I'll propose 3 alternative explanations or 3 complementary explanations to the literature. And finally, because this is a FinTech conference, so I'll discuss a little bit the possibility that algorithms themselves can be biased. So first of all, do VCs use machine learning? So we have anecdotal evidence that suggests that yes. And for example, in 2019, more than 25 VC funds were using VC in the US, and 56% of surveyed VCs expect to use it like in the future. So according to a newspaper article I found, we also have evidence that AI-driven hedge funds outperform conventional ones. Okay, so on actual data. And so the question is, where can the technology be useful? So it could be useful at the pre-screening stage, like as opposed to introduction in the VC world that are made through connection or through the network. And it's, for example, what Paul Gompers and his co-author shows. So 60% of deals in the VC industry are made through the VC's network. Okay, and only 10% of startups that ultimately receive VC are unconnected. Second, so that the technology could be useful to aggregate some information. about startups, competitors, potential acquirers, or even matching like some co-investors, and typically using Crunchbase or AngelList that are databases that VCs use. And finally, it could also be useful, to have like a data-driven approaches to evaluate startups. And this is, for example, what Songma does in his paper. So analyzing videos with some algorithms. So are algorithms more reliable than humans? Yes, I mean, in that sense that they can make more consistent decisions over time. And but the next question is, could investors use Victor and Leah's algorithm? And the answer is, I think no, because they would need to access some restricted administrative data on 100,000 of startups and private firms, and to access their balance sheets, income statements, answer to this survey. And the problem is that only researchers and policymakers have access to this data set. So, and the reason is that if financiers or competitors, they have access, they could see the answers to the survey, this would modify, the incentives of entrepreneurs to truthfully answer it. So that's why, this survey is not accessible outside from universities and policymakers. So my suggestion would be, first of all, to validate the exercise by doing some external validities and on data that investors actually have, and also to use the history of high-performing VC-backed deals to predict future deals and then quantify the differences. So my second comment is about why does AI do better than VCs? And basically the paper explanation is in line with what the literature has shown, that early stage investors, they rely heavily on their network, or they may have some biases because they lack some quantifiable data to evaluate pitches. And as a result, they overlooked minority-led startups. So I'll propose like 3 complementary explanations to this, to the explanation that have already been given by the literature. So first of all, some high-performing firms may not want or may not need to be backed by VCs. So the second one is that VCs may have different preferences beyond pure performance. And finally, VCs may not use the log of the value added at year 5 as a measure of performance. So about like the first alternative, so VC financing is a two-sided decision. VCs are active investors, they take board seats, or they take also equity in the startups. And traditionally also, the French economy rely more on debt to finance new firms than the US, for instance. So, and this is data that I had in my job market paper. So you see that bank loans, like 30% of firms that are created in France, they use bank loans for the corporation or household debt as well. So basically my first suggestion would be to check how AI selected top performing firms are financed. And this is more or less what Paul Goldsmith does in his paper. So the second alternative I would like to discuss is that VCs may have different preferences beyond backing pure top performing firms. And why? It's because VCs, they have a portfolio approach, so they care about the skewness of the distribution more than the average. And the paper basically compare the average VC-backed startups and not the top VC performance. That is what should drive the performance of VCs overall. Relatively, VCs are willing to take risk on startups. So VCs, they tend to back more innovative startups in different industries. And this is also what we can tell the social function of VCs. And this is, for example, the argument made by Nicholas in his book. Or also, we also observe that VC selected startups, they survive less because survival is basically like a mix of performance in terms of the first moment and the second moment. We also know that VCs, they invest locally, and VC firms in France, they are all located in Paris, so which may explain why they invest less in outside from Paris. Victor also discussed that they not only provide money, but they also provide advice, and that the performance are endogenous of VC advising. Okay, and all I'm discussing, all the specificities of VC investment are actually supported by the VCs. So for example, VCs, they tend to back, they have in their portfolio entrepreneurs who say that their motivation is actually to have like a new idea for creating the firms, or for example, that they also have like more innovation, like the difference is positive in favor of the VC selected firms. Okay, so this is, even in the data, they have heterogeneous preferences. And one thing to notice is that the sample that is used by the authors actually contains not only newly created firms, but also subsidiaries of groups, okay? So AI selected firms in the data, they are much bigger and older than firms that are selected by the VCs, okay? And one specificity of the survey is that we observe VC financing only in the first wave of the survey. So basically they are comparing firms that are not exactly similar. So my suggestion would be to compare apples with apples and to run the algorithm of the pre-matched sample of entrepreneurs at creation. And yeah. Okay, and finally, like VCs, they may care about different measures of performance, not only the log of the value added at year 5. Okay, so they commit, first of all, I mean, LPs, they commit for 10 years. Also, I don't understand why you take the log, because you're modifying like the distribution and eliminating the negative values. I mean, in terms of measure of performance, you could use, and these are measures that have been commonly used by the literature, for example, the sales growth, the employment growth, the EBITDA, and not the value added or the log of the value added. So I recommend that you don't take the log, you consider more commonly used measures. And yeah, okay, and finally, algorithms can also be biased, okay? I mean, this is, I mean, not only related to Victor's paper, but they are trained on data that are not exactly similar, and especially algorithms are not equally trained on minority groups, which may create some cross-sectional difference in screening efficiency. Okay, so, and actually, Adler, Morse, and co-authors, they propose a test to evaluate, whether an algorithm is biased or not. So I don't have time to discuss, so sorry about that. So to conclude, the paper basically shows that AI selected firms outperform VC selected firms according to the algorithm they develop. And they also show that the algorithm select younger entrepreneurs and more female-funded startups and non-Paris-based startups. So the key ingredients of the paper are, first of all, a topical question, a machine learning algorithm, and great data. So my suggestion would be, first of all, to consider more common measures of performance, to compare firms that are comparable on a pre-match sample, for example, and also to discuss some alternative or complementary reasons why VC do not only back the top performing firms, and also to clarify the contribution of the paper relative to the existing literature, and in particular to explain when this exercise is relevant. So thank you very much.